The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Chung. Now, President Donald Trump's new tariffs were larger than expected, and the economic fallout, including higher inflation and slower growth, likely will be as well. That's according to Federal Reserve Chair Jerome Powell. Now, those remarks point to the potentially difficult set of decisions ahead for the central bank. What does this mean for investors, though? Are there any attractive investment opportunities for investors in the current market? Well, to find out more, joining me now is Vincent Chung, who is the co-portfolio manager for Diversified Income Bond Strategy at T. Rowe Price. Vincent, welcome to the show.
Great to be here.
Thank you so much for joining me. Well, Vincent, just to start off our interview here, given the slew of tariffs imposed by President Donald Trump, I mean, he has issued a pause at the moment, but has the risk of a higher U.S. inflation rate increased?
Yeah, sure. So in terms of how we're thinking about it, in terms of short-term impact, there's definitely going to be some inflation that's going to flow through the economy in the U.S. So what's interesting from our point of view is that inflation for the U.S. through goods may actually be deflation for the rest of the world, as the goods that are being exported out of China will have to be rerouted and has to find a place somewhere else. So in terms of thinking about the inflation impact, it might be different for different parts of the world.
Okay, fair enough. Well, analysts say such tariffs will amplify the risk of recession later in the year. I mean, as consumers traditionally dial back spending activity when they feel that their wealth has been eroded, right? So, Vincent, could we see a recession later in the year, and what would that mean for financial markets?
Sure, very topical question at the moment. In terms of the main adverse scenarios that investors are most concerned about, one is what we just talked about, sort of a more stagflationary scenario. And then two is the chance that we could go into recession in the latter half of the year. Some of the key things that we look at in terms of as a team is, do we have the transition from soft data, things such as surveys, etc., moving into hard data, which in this case, I think the key is the unemployment rate. Now, the employment rate going up is probably going to be a lagging indicator. Things that investors could look at are things such as the initial claims, if we started to see pickup in terms of the hiring rate. We might even also get some details in the earnings calls that are coming up in terms of whether corporates are really willing to let workers go. Because we haven't really seen a deterioration from the unemployment market. That's going to be the key decision point of whether or not we are in a more stagflationary type scenario, or are we going to get into a more recession scenario in the latter half of the year. Now, the obvious point of pointing out is volatility has increased. And so these scenarios have increased in probability. We tend to think that if there is some fiscal support, either from more tax cuts being enacted, and I think the administration has an incentive to push that through now, we might lean in toward the stagflation scenario, which is quite different in terms of the asset outcomes for investors.
Okay. Well, then, what will this mean for the trajectory of U.S. Fed's interest rate cuts then? I mean, could we see the Fed cutting interest rates more than previously expected? What are you predicting here?
Right. So the market is pricing about 3.5 to 4 cuts for this year alone, and a further sort of one cut in 2026. So to end at somewhere close to the low threes in terms of the interest rate. That's obviously a combination of the distribution of scenarios. In a recession, they may end up actually cutting more. If it's in the stagflation scenario, though, where growth, which is now predicted to be about 0.5 to 1% in terms of the U.S., if we start hitting that higher end, i.e. we don't have this spike in unemployment, and there are some dialbacks in terms of tariffs, there is a deal, for the major countries. So assuming some walk back, the stagflation scenario could be very difficult for the Fed in terms of actually doing that 3.5 cuts. You might be talking more scenarios of where we're doing 1 cut, 2 cut. If the economy actually manages to stay relatively resilient, you might not even have that 1 cut scenario, which might sound as a very low probability scenario right now, and it's not our central scenario. But I think what we've seen in the last 6 months is the market pricing out almost all the cuts to pricing in a lot of cuts. We had this last year as well, where we had up to 6-7 cuts being priced in. And I think there's a bit of a schizophrenic reaction in terms of the opposite scenarios are so different. And for the Fed, it's very hard in terms of navigating this. And so for investors thinking about, is there a Fed policy put? In a way, the inflation will have a very confusing impact in terms of how the Fed is going to analyze that. And the second part is, are they going to be timely? If it's in a stagflation scenario, there is less probability that they'll be able to react proactively and in time. So there's more chance that they might be reacting too late to help and give that liquidity to the markets, which would help risk assets.
I mean, there's no doubt with the whole uncertainty and the unpredictability in the current financial landscape. I mean, given these outlooks, then let's dive into some investment opportunities. So, based on the current market conditions, what are the most attractive fixed income sectors for investors seeking sustainable income, and how do you balance yield with risk in today's environment?
So the one thing that investors really can decide on is what's the purchasing yield that they get into their investments.
Right.
Looking at across the different investable universe for the typical investor, I would say there has been a reset in valuations. It's not pricing in any recession scenarios, but I would say that it has definitely incorporated a lot of the increase in volatility by looking at measures such as the VIX, looking at credit volatility, looking at volatility that's priced into other assets such as fixed income, FX volatility, as well as, in general, the back end of the equity markets as well. So not just the front, which we had in last year, where we had a spike in volatility in the front end, so being priced in as sort of short-term impact. The uncertainty now is being priced also in, call it 3 months, 6-month periods, slightly further out. So investors are demanding a little bit more in terms of compensation to hold that risk. Now, with the reset in yield, as I said, being quite an important part as fixed income investors, we do think that parts of high yield, particularly in the last week or so, there were interesting portions of it where you are getting a bit of dislocation that funds and investors can take advantage of in terms of the discount versus the NAV, even if it's in an ETF format, and also versus where you would expect it versus some of the historical betas in terms of versus equities, but also versus, different asset classes. So we do think that the yield increase is notable. It's not a time where you necessarily want to have everything in because there is still that uncertainty scenario 6 months down the line. But as you have this increase in yield, slowly increasing your allocation to riskier parts of the market, it definitely makes sense to slowly start enacting that.
Okay, you talked about, the income or fixed income allocations there, asset allocations here. Are there particular strategies, such as barbell or laddering that you would recommend to optimize income generation while minimizing risk?
Of course. So the barbell approach that we typically talk about is you have very safe assets with very dislocated high-yielding assets. In this instance, I would actually say that you probably want to be closer to the belly in terms of going down a little bit in terms of the credit spectrum, but going to underwrite credits where you're very comfortable in different scenarios where the companies do have either refinancing options that doesn't require the market to be open, but also has some ability to weather because of liquidity within their own balance sheets. Why do I say that? Because the scenarios can be pretty bifurcated, as we talked about the economic scenarios. One thing that investors do not want to do in fixed income is to take an impairment loss. I think that's pretty crucial right now, is to not have too much exposure into jump to default type credits. Particularly the barbell approach actually last year has worked really well. So you're into a sort of lagging trade that was already performing quite well. As we know, last year, triple Cs were one of the main reasons that high yield managed to do relatively well. And that is a very carry-heavy factor in terms of fixed income. So this year, we think that you can take risk as you get the sort of higher rated segments, even within high yield, starting to revalue higher. Those are probably the sectors which are a little bit easier to recommend to investors at this point in time, because we haven't had the full valuation reset where you go, you are just fully compensated for that default probability increase.
Some very interesting insights there, Vincent. Well, with the global economic landscape in flux, do you see emerging markets debt as an attractive source of sustainable income as well? I mean, how do you assess the risks involved in these investments, particularly with regards to currency and geopolitical factors?
Sure. So I think what was interesting in the last couple of weeks is that typically, investors would have expected emerging markets to really underperform. But actually, because the way that the dollar has behaved, it has probably helped to negate some of that historical negative impact in terms of currency impact on top, which means that those markets have actually outperformed. Now, in terms of for fixed income, we do know that emerging markets is a residual asset. So what do I mean by that? It means that if I think about what core investors would invest in, investment grade, US high yield, then you are starting to think about emerging markets because you require risk premium on top. Now that we know that there's a residual type assets, it's very hard for US credit or US centric assets to do poorly whilst emerging market actually going in the other direction. So there can be a period of outperformance, particularly because there is such a bifurcation, dispersion of credits out there. There are a lot of countries. We would recommend investors to, again, go into markets where there is a local investing and refinancing opportunity for both the sovereign debt as well as for corporates, where corporate fundamentals are starting from a very strong position. And so they have some liquidity to weather if there is going to be a slowdown. But also they can refinance in potentially the local markets. As we saw in the last couple of weeks, US-centric assets as a whole were starting to see a little bit of stress. So you don't want to have to just refinance with in the US-centric type of refinancing channel. That means that if your country has ability to tap the local savings space, they have an opportunity to outperform. I'll give you an example. If you look at the India market, we did have some dislocation starting to happen India credit, even in IG, which is quite a safe investment. They don't necessarily have a ton of exposure into tariff impacts. A lot of it is internally local derived revenues. But if you look at the performance of local bonds, for example, in India government bonds, they actually went down in yield despite all of this. So I think the investors should think about different demand base for their instruments of choice. So different investor base means that there's going to be more liquidity, which is something I think investors should also prioritize over.
Okay, we talked about the different investment opportunities here, but how important then is diversification in creating a sustainable, income portfolio? What strategies do you employ to ensure a well-rounded approach, particularly when interest rate hikes are affecting bond prices?
So we just touched upon one of the topics in terms of a way to create that income. One, by going into different geographical exposures, i.e. having different types of end investor base of those assets. That's definitely should be top of mind for investors. The other part is not having a structural overweight in particular parts of market. Historically, investors have been very gravitated towards US-centric assets. We think that investors should be willing to have that exposure when you're fairly compensated for it. But there's going to be times when rotating between different sectors, as you pointed out, emerging markets, different parts of emerging market, rotating also into European credit, where the story in terms of some fiscal tailwind for 2026 and the fact that the ECB is going to be able to have room to cut and provide some monetary policy stimulus, those interesting opportunities for investors to build a more diversified portfolio of income. And that's what investors should be doing today, is diversifying sort of resources so that if they have to do a reallocation, they can actually sell it and go into something that's a little bit more dislocated. So you have some optionality even when you are investing from a ladder approach.
Sounds fair enough. Well, before we let you go here, Vincent, just to wrap up our conversation here, do you believe that a tactical short-term approach to income investing is more effective in today's market, or is a long-term strategic approach still the best way to ensure a steady income stream?
So I think both have valid approaches.
Okay.
So if you are looking at longer term, as I said, the thing that's going to determine most of your returns is the entry yield that you get in. So if you are willing to deploy money, have a target income in terms of the yield that you are satisfied with, that is competitive for a compensation over cash on a reasonable amount, then I think that is not a bad tactic to go for. If you are looking to do short-term allocation decisions, again, I would say that being very flexible, if you think about market cycles right now, they have been compressed into, call it, 2 to 3 years. Being aware that you are going to have to impose a market cycle on top of a business cycle, and the fact that is we have more risks and the intermediary channels of you being able to transact can be quite small because there is a lot more debt that's outstanding, and we don't get the sense from primary dealers' balance sheets that the exit is getting any bigger. You just have to be aware that when you're making those allocation decisions, you're not doing it at the worst point where, for example, the yield is now starting to become very attractive. So being able to have that flexible approach, I think both have validity. If you're not willing to look at the markets and look at the fundamentals of how they evolve over time, it may make sense for you to select a manager who has a track record that can help you make those decisions. But otherwise, I think as the yield goes up, investors should start to think about what is the yield that they can lock in, and that's going to be the predeterminant of majority of their returns over time.
All right, some great insights from you there, Vincent. Thank you so much for joining me.
Thank you very much.
Thank you. That was Vincent Chung, who is the co-portfolio manager for Diversified Income Bond Strategy at T. Rowe Price. This has been the Wealth Tracker with me, Hongbin, Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.